Welcome, ladies and gentlemen. My name is Brad Matheny. Today is February 4th, Saturday, early in the morning in California. I want to start this video off by alerting you that things are going to be changing at the end of this month. I will no longer be posting these free videos in the frequency that I have been over the past couple of months. I've been giving away my research for free to try to let people see and experience what I do. I am moving everything into a service called Expert Growth on MENT.com. Please visit MENT.com to learn more about what I do and how I can help you. This includes everything I do, including my SPY cycle patterns, my predictive modeling, my advanced research, which you're benefiting from in this video and my other videos, as well as my weekly detailed analysis about what's going on. So visit MENT.com. Remember, it's fairly simple. I do all the research and I give you all of the tools to be able to make great trading decisions. All you need to do is follow along, learn to use the tools that I provide, and learn to become a better trader. I've gotten some great comments over the past couple of months from members on Twitter and via email. They love what I do. They love the detailed work that I do, and I will continue to expand out my services and build new technology to help you. One of the things that I am going to try to do is convert the MENT live trades. This is the MENT live trade service into something that's more interactive, database driven. This will probably take a month or two to get it done, but understand that this is one of the primary drivers of trading decisions for all of you. When you're subscribed to the MENT Expert Growth Service, this is the MENT Expert Growth members page, you have access to all types of information, including my detailed reports, getting started video, a worksheet to help you understand how to trade. You have my members updates, my video analysis, my custom indexes, which is what we're going through in this video, my weekly TT scanner hot list, member support, and of course my account. You also have access to the Trade Tank message board and the live trades. Under Expert Growth, you get everything that I offer, including my SPY cycle patterns. So here we go. First off, visit MENT.com. Tell your friends about what I do. Remember, it's basically very simple. My services consist of three things. Expert Growth membership is my research, my proprietary information, essentially trying to help you become better traders. Fully automated trading strategies for those that are interested. I offer a number of completely fully automated stock, equities, ETF, and futures trading strategies. And then I do a lot of custom consulting for individuals and bigger firms throughout the world with regards to my predictive modeling and software development. Mostly focused on stock markets and predictive modeling technology. Okay, guys, so be aware. I want to help you, but I also have to turn this into a business and stop, spending thousands of dollars a month to give away free research. So here we go. First thing we're going to do is go back to the SPY daily chart. And if you had been following me for a while, you know that I had been predicting the end of a wave 4 move to the downside, starting potentially a wave 5 move. We have come up to the resistance level that I had indicated, which was to get above this level and to run into resistance level right over in this area. I still believe we have a chance to get up into this high eventually, possibly even up into this high. So let's call that 440 and 431. But I believe we're going to be a very labored upward move. Okay, I think what we're really looking at is we've seen this upward move, and I want you to understand my count. So the way I look at the markets is to first off try to identify where we're at in the concept of new versus unique highs. This is a unique high. This is a unique high right here. We are above it. We are struggling to confirm the trend above this unique high back here. The only other unique high that we've had, well, we had a little one back here, which qualifies as a unique high under Fibonacci price theory, but this one is critical. This is the make or break level where we are going to either determine that we're going to trend higher, which I believe ultimately we will resolve to the upside after basing and bottoming, but we also have a unique low way down here. We have a moderate unique low right over here, meaning this is the newest unique low. This one is really defined. This one is extremely well defined, ultimate price support. So in this instance, ladies and gentlemen, as you follow my research and follow what I teach you, I see a fairly broad range, typically between this area, 374, 375 on the SPY, up to this area, which is our current high at 318. I would say that we have a potential to move up to this high right here at 432. We are in an uptrend. We've just broken above this unique high right here, this red bar. And what I believe is going to happen is that we are going to run into some consolidation, staying kind of in this range through most of February, maybe even into March, and then move into a melt up into this area into the summer months. So I believe we're going to be looking at a moderate melt up. Understand that this is nothing to be super aggressive of. We're going to have roughly a, so let me figure this out. Get the percentage numbers up. And then we'll play with this sucker. We have about a 7-8% rally phase left for essentially the into June, July, maybe up into the 8-9% range. That would be up into this area back over here. This would be a stupendous move, in my opinion, for the S&P to do this before the end of the year. But we also have the ability to see, so we could see a minus 2.5 to 3.5, maybe 4% rotation. We could see a 4 or 5% potential volatility continuing forward. So again, the way I'm measuring this, just so you know, ladies and gentlemen, is I am taking a look at how we've seen this volatility. So we've seen, you know, fairly solid unique price ranges. Let me give you an example. So I'm just going to draw from this low to this high, and then what I'm going to try to do is come back over here and drag it. So here we have from this high to this low, that's from here to here, and then we have from, got to make sure I can get this thing. There it is. Then we have this breakdown, which goes from about here to here. Then we have this rally phase over here that goes from here to here. See how these ranges continue to repeat themselves over and over again? Here we have a low to high from here to here, and here we have a low to high right over into here. Same scenario, ladies and gentlemen. In fact, I could show this to you over and over again on the chart. So that means that if we were to see this melt up continue from these levels, if we were to pull back down into this green area right over in here, as markets rotate, which is highly likely over the next 20-30 days, moving into Q1 earnings in April, we would likely see support down around 400, 403, 401, somewhere around there, finding support down here, and then slowly melting upward into this 435, 440 area, which matches this area. So hypothetically, where's my pencil? We would be looking at a move potentially up, like we've seen from this area, stalling out back down into this area, consolidating, rolling, rolling, rolling into maybe 430, 440, maybe by August, September, October, at which point we would likely then see another stalling of price, possibly back down into this area, and then another move like this, duplicate, keep dragging the wrong things. I think I'm duplicating the, there we go. What happens when you have too many things on the chart? There we go. So from here, if we were to stall, we would then be looking at a wave C formation, sorry, wave E formation up to around 455, 457, maybe 460. So we have kind of a structural wave formation here. This is really A, B, C, potentially up to here, forming into a downtrend. Now C here would likely extend. We could see it move up to this area. This would make it a good solid wave C. But more than likely what we've seen here is an A, B, C, indicating that we could come back down into this support area potentially before we then see that would make A, B, C potentially up to here. And again, if I can try to draw that for you. We'd be looking at something like this. If this count plays out the way I think, this being an ABC wave up, if this is the case, then, and this is a correction, then we either get a C wave somewhere here to here in this area, followed by a correction, followed by a new wave higher, and it would possibly even be much higher, but could be extended time-wise. In other words, I'm drawing this on this chart. It may not move exactly like this. It may be more of an extended wave out to here, rolling around, back down to here, rolling around, back up like this. Okay, so understand that we could be in an extended rotation like this, but understand that if this turns into the end of a wave 3 or a wave C, if this is A, B, C, actually we have A, 1, 2, 3, C, D, so that could be wave 1, wave 2 down. This would be a wave 3 up to here, would normally be bigger than wave 1. Then we have a consolidation, and then wave E would be bigger. That could still be wave 1. And that could then, ladies and gentlemen, put us into a much larger Elliott wave cycle to the upside. And let me come over here and try to just play around with this a little so you can see. So hypothetically, if we look at these cycles and we were to determine this as the structure from these lows, we have A, I'm not drawing anything, we have A, B, C would extend larger than A, potentially out over into this area, then rolling back down, and then possibly, as I mentioned to you, near the end of this year, moving up into new all-time highs. And that would be a fairly solid structure for wave 1 of this uptrend. Wave 2 would then form somewhere over here, consolidate, and then we would start wave 3 even higher. So understand that we're really going to see a labored, struggled, in my opinion, move to the upside for the next 6, 7, 8 months. Through the end of this year, we're going to see a fairly labored move, staying within this kind of a tight range here. I would be very surprised to see the SPY above 455, 454 before June, July, August. After June, July, August, I believe the predilection, so to say, of upward trending will become more dominant and will start to drive us up to new all-time highs near the end of the year, possibly beginning of 2024. But for right now, I see the markets struggling. I see the unwinding of the global excesses continuing to unwind, continuing to play out, and I believe we need at least 6 or 7 months of continued unwinding and consolidation and basing before we're going to see any real upward trending. Okay, now, I've given you this data. I want you to pay attention to it. I am trying to forewarn you that this is not the time to be an aggressive long or short. This is the time to play conservative, tight trades. You're going to be looking at maybe 4, 5, 6, 7% swings, maybe. You're not going to see these big 13, 14% or 40% swings like we saw just recently in technology. Now, some undervalued stocks may see these 20, 30, 40% swings, but you need to really get in, get out, protect your stops, and address this from a long-term basing momentum. Everybody likes to throw up. In fact, let me see if I can come over here and see if I can pull up a chart, anything to show you what's going on. All right, this is fine. This is SPY. Let me resize it. Everybody likes to throw up these huge, massive charts showing you the crisis phase of the market top. Everybody, for some reason, I don't know why my mouse is not cooperating. Let me try over here. All right, whatever. Somehow my mouse is getting to the edge of these things and just not cooperating. So here's what we'll do. We'll just leave this here, drag this over, go to monthly, and rescale. Everybody loves to show you these big, long, look, we are here charts. Big, long rally. Look, rolled over, formed a little R, and then they show this big, massive downtrend. And they always point to areas like right here where they go, look, we are here. Right here. Extend trend. They're always pointing to this area saying, we are here, right over here. What they fail to understand is that this is an excess phase peak pattern. This whole setup, this big broad peak pattern is an excess phase peak pattern. And yes, ultimately, if we get below this low over here, which is actually this low right here, if we get below that low, then yes, we will come down more than likely and establish a phase 4 base, which will probably be around the middle of COVID levels, and then bounce, and then maybe come down a bit further. Maybe. Each and every one of these can turn around and can go to the upside. So from this point here, we could rally back out of this. It is nothing more than an excess phase peak pattern that has failed. So here, for example, is a rally phase and an excess phase peak pattern that failed. Here is a rally phase and an excess phase peak pattern that failed. Here's a rally phase and an excess phase peak pattern that failed. Same thing here. Same thing here. Same thing at every major turning point in the market. I mean, I can go over and over. Here we had a rollover. Oh, look, I had a rollover. Oh, look, another excess phase peak. A rollover, another peak. A rollover, another peak. A rollover, another peak. Eventually, yes, they do collapse. There will be some catalyst event. But every time, I mean, I can go down here to a weekly chart and show you even more. So look, just pick a time, go, oop, didn't want that. Go way back into these time frames, and I can show you dozens of excess phase peak patterns that have failed. Okay, look, here we go. Rolled up, rolled down. Okay, there we go. Excess phase peak pattern, rolled 11% higher. Excess phase peak pattern, rolled out of it, rolled 4% higher. Excess phase peak pattern, rolled out of it, consolidated, rolled 11% higher. They're all over the place. Every single one of these people that tell you that this is it, this is the collapse, they fail to understand that there's two sides to the coin. There's the downside, if it comes true, or there's the reversion trade that goes back up. And that's what I'm trying to tell you. We are not at a point yet where we can call this a crisis phase. We cannot call this an excess phase. Well, we can call it an excess phase peak, but until this critical low back over here is taken out, this low right here, we are safely in the apexing formation of this flag, which is from here to here, and roughly from here to here. This is, in my opinion, the next big phase up. If this fails and takes out this ultimate low, then yeah, boys and girls, we're going lower, and it could be ugly. At this point, until we establish this, knowing that this is a completed, or hypothetically knowing that this is a completed wave 4 to the downside, showing us very clearly an A, B, C, D, E formation, I'm believing, under the belief, that we are going to phase out of this into consolidation and eventually move back to new all-time highs and eventually reach that critical cycle peak in 2027, 28, or 29. Okay, so you hear me talk about this all the time. I just want you to be aware that there's going to be a ton of people that are out there telling you to short the world. The world is going to collapse. And I'm not saying they're wrong. I'm saying not now. Not right now, unless there's some major catalyst event to drive us in that direction. I don't see it happening. War or major financial crisis, huge pandemic problems, yeah, I can see it happening. But right now, we're kind of away from those criteria. Okay, so now I'm going to come back over here, and I want to focus you on this this cycle phase, this volatility index. Now, what's very important here, ladies and gentlemen, is to understand that we've broken out of this downward cycle trend, this red line and this magenta line here. And now we've moved into this moderate upward trending. This is very solid bullish trending. Okay, this actually indicates that we are now in new territory, new moderate bullish trending. Yet, I do believe we could stay in this 8, 9, 10, 11, 12 area for many, many weeks, maybe towards July, August, September, October, pushing up into this 14, 15, 16 area, but this would be very solid trending. Remember, what we saw back over here in 2020 and 2021 was the same type of melt up, which extended the trend higher until the 2021 roughly peak over here. So this was extreme speculative bubbling. This was momentum building in a trend. If we continue to get into that momentum building in a trend mode here, we could be up in the 12, 13, 14 throughout the rest of this year, meaning staying within this, say, 8.5, 9 area to this, say, 13, 14 area all year long. Just rolling into a moderate melt up. Call it a labored bullish upward trend. Kind of like what happened in 2003, 4, 5, 6. Eventually maybe getting up to new highs, maybe getting above it, and then actually getting some real big numbers over here, 15, 16, 17, 18, showing extended upward trending. But I believe we've broken out of this cycle and we're now in an uptrend. Next, we have the valuations chart. I believe that one of the reasons why we're going to stay in a labored upward trend is because I believe valuations are going to stay consolidated after this big unwinding phase from the COVID speculation. I believe we're going to stay below the 65, 75 area and just labor forward with a moderate melt up. That's why I'm warning you that it's going to be a very good time to stay cautious and not get overly zealous trying to short the market or go long the market. This is really going to be a trader's market. You see 3, 4, 5, 6% in a trade, take it and lock in some profit. You're not going to see a bunch of big moves in major indexes. This is an older chart. The weekly U.S. stock market index has broken out of the flag, just like I talked about. We do have resistance up here at the Fibonacci price amplitude arc. So be aware that we're going to run into resistance up here. Again, that's very similar to what I was showing you back over here on the SPY. You can see I've drawn this price amplitude arc over here. We're going to run into some resistance right over here in the 420, 425 area. And that's really where I think we could see the next phase of this rollback over. Okay? Let me go back over here. So pay attention. Right up over here would probably be around 420, 425. We could run into resistance within the next 2 or 3 weeks, hypothetically, and then potentially stall out. Next we have, well, let's go to those in a minute. Let's go to the Smart Cash Index. This is the global Smart Cash Index. You can see we've broken out of this range. We're reaching some resistance here. And this resistance really ties back to these areas back over here and this post-COVID consolidation range. So we could see the market stall out over the next 2, 3, 4 weeks, moving into kind of, like I told you, a labored melt up. But I'm seeing, really, we've seen a reflation trade. I'm really concerned that we're going to see some stalling. It's not going to be the same type of reflation upward trending. I'm thinking we're going to get 2, 3, maybe 5, 6 weeks of stalled sideways activity, maybe with a moderate kind of a bias to the upside. Same thing kind of with gold. Gold is rolling over. This is the custom metals chart. I expected this. I'd been warning you since back over here. We're going to get some sort of a pullback. Just didn't time it efficiently. Long and short of it, we're in a broad cycle uptrend, and we're going to run into support right around these apexes. We've had numbers of apexes right in this area, so I would imagine right over in this area, 412, 415 is going to be very solid support for gold. That means that we could move down another 3, 4, 5% in gold to try to find support, and then we're going to start another leg to the upside. Watch my special gold and metals video this weekend for more information, but this is standard. The dollar is going to probably try to find some support, especially after the Fed. We might see 3, 4, 5 weeks of upward dollar momentum. Gold will likely stall and struggle around 415, 410 on this custom index chart, and that would put it, in my opinion, probably somewhere around 1860, 1870 stalling for gold. But then we're going to find support, and it's going to continue to rally back up. The FANGs index has really started to move higher. This doesn't reflect the big move we saw in Tesla and Microsoft and others, but we're back into this basing, bottoming back over here in June, July, and really starting kind of a melting upward type of scenario. We could see a fairly big move. We could see it revert back up into this area, but we're near the standard deviation channel, and again, folks, any big pop in the FANGs index could put us, really, near kind of a resistance area. Technology is going to keep making money. I had a talk on Twitter with a guy about this just yesterday, about, how he was obviously betting that Apple was going to collapse on earnings data, but you need to understand these companies are making hundreds of billions of dollars every quarter, and even if they go down 3 or 4 or 5% on some missed earnings or slower sales or what have you, they're in most cases, very well diversified, and they will continue. So I mean, Apple, hypothetically, if Apple has a couple of bad quarters, they're going to go from making $460 billion this year to maybe 440 or 430. Still, it's a huge amount of money. It's like, kind of like saying, well, you made you run a business, you made 400,000 one year, and then you made 380,000 the next year, but your average cost of doing business was 220. You're still making 160 grand profit every year on your business. I mean, is it really that much to be, think that the whole world's going to collapse on a 6 or 7 or 10% collapse in gross revenue? No, you're still making 60%, 70% margin on your cost of doing business, and it's just a little slowdown. So I think that's kind of where we're at. There's no catalyst for a big market collapse yet. There's probably a bigger catalyst for a reflation trade, possibly back up into this area, 350, 370, 380. Okay, next we have the metals trend index. This shows you kind of where we're at from a different perspective for metals. We've gotten above the previous highs. We've actually built a very strong momentum base here, and the next phase is going to be up to this 14,000 area. So give it a couple of weeks. This is a monthly chart, but give it a couple more weeks. Let gold settle back out, maybe around 1850, maybe around 1840, and then I think we're going to see a fairly good sized move up to 21, 2200, and then establish a new base up in that area. The custom commodity to gold index, again, very similar to my valuations chart. I really do believe that we're going to stay muted down in this, 3.5, 3.4, 3.6 area or lower. And this is a real unwinding of commodity excesses. The Fed's trying to put pressure on the U.S. inflation trends, but that's also putting pressure on global markets. So we are going to, transition out of this. The markets are still functioning, but I think we could stay fairly consolidated for 12, maybe 18 months, maybe leading to a 2024 breakout, but I think 2023 is going to be very muted, very consolidated. Okay, the volume ratio index stalled out last week. I was hoping for something up here in the 10, 11, 12 range that would tell us that we're seeing some real capitulation in an upward move. This moderate capitulation over here kind of reminds me of these little, chunking along, building momentum through 2020 and 2021. Same thing back here in 2019. We don't have any real big capitulation move. This was a big change of direction here in early 2022, and these were the bottoms in June and July and August that actually changed direction. I see volume as being rather muted. I hope traders are aware that this is going to be a struggle for the markets to find some real momentum. Yeah, there could be a couple of outliers that move 20, 30, 40%, like Tesla and others. But I think generally the markets are going to stay very labored this year, struggling to find real big trends. Okay, the leading index is rolled over. We've got a nice little doji setting up over here. We're above this upper channel, way above this inflation or this standard deviation channel. We're back into kind of a bubbly territory, which is again why I think we're poised for a pullback, ladies and gentlemen. We could easily come back down into this 1.8, 1.9, 2.0 area and consolidate, possibly consolidate through all of Q2 and the summer months. Remember, we're only a couple months away from the May-June cycle in the markets. So, and the markets tend to flatten out. If we don't have any real impetus and the Fed continues to force or try to battle inflation, we could move into a, kind of a mucky, sloggy, go nowhere trend come April, May, June, July, August. Still, I think it's going to melt up. It's going to labor and bias to the upside, but I would expect us to be down in this area, the 180, 190, 2.0 area, before we get to April, May, and then slog forward into a new upward trend. All right, next. The custom valuations index, great example of how The buying that we've seen in certain technology stocks and certain sectors has not translated into real valuations expectations to the upside. So we have not seen this type of breakaway upward trending yet. And we may not see that for another 2 or 3 months. So again, warning, I believe we are going to be in a consolidated, labored trending mode. So be aware. I don't think we're going to see any big trends, any big opportunities. You need to be very cautious. I also don't believe we're going to see any big breakdown events. We may see a couple of short-lived breakdown events, but be aware. We are probably going to be trading sideways, basing, and bottoming for a while. Maybe doing something like this, where we hit an established low, consolidated for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months before we finally got out of that mode and started to see real price appreciation here. Okay, next. U.S. to global market index. U.S. market caught up last week to the foreign markets. This was way down here last week, very low compared to where we were in the global markets. You can see that we've got the peak in the U.S. price index here. Did not correlate to a price peak here, but we can kind of correlate it to this one back here. We also had this price peak here in the foreign markets, which kind of correlates to this one. So the U.S. and foreign markets have realigned, is what I'm trying to tell you. In my opinion, they've realigned. And now, because of where we're at in the foreign markets, back up just into this consolidation area, I would expect the U.S. markets to maybe trend a little bit higher, maybe 2, 3, 4% higher, and then roll over and follow the trend here. I expect the global markets to roll back down into this area, try to find some support, and really, like I said, slide into Q1 earnings, which will be Q2 in kind of a malaise. Just really a go nowhere, slide sideways, maybe biased to the upside kind of mode. Okay, tech ratio index has seen a nice little bounce. This was a beautiful little bounce. It did not equate the big move we saw in Tesla and others. I want you to be aware that we could see a continued melt up in the technology sector. It's going to be volatile. Boy, you better be prepared for 6, 7, 8, 10% price swings, if not more. But we could, by the end of 2024, see this reflate back up into this 45, 50, maybe even 55 area if there's no big disruption in technology. Consumer sentiment index related to real estate. We've gone from extreme hostile territory to weakening territory. Understand that this was very, very similar to the hostility level that took place prior to the global financial crisis. So we're at levels right back over here, the top of this purple level. We're at levels that are extremely hostile for real estate. I believe we're going to see real estate move into a downward pricing cycle, turning negative year over year by probably May, June, July. And depending on what the Fed is doing, I believe we're going to start to see some real pressure on the markets, which again increases the ability that we could have some catalyst event in the future, possibly foreign catalyst event. But as long as the Fed keeps the pressure on the market, this could be kind of a labored downside move, kind of like this. So imagine this, but starting from way up here, moving in kind of a labored downside move, which may last 2, 3, 4 years, where the markets really contract. And again, that means that the bubbly areas may stay somewhat bubbly for a while, but eventually they'll start to roll downward. The real volatile areas like Vegas and other areas, they could see a more sharply defined price decline simply because they are, Vegas went from average house prices on probably $130, $140 a house to $350,000, $360,000 a house. It was a 300 or 400% increase. You could see that unwind very quickly. Okay, next. The fear index is down at 5.52. S&P is climbing higher. Remember, this is our real critical unique low or unique high right now. So we are not out of the woods. We're in this consolidation phase. It's looking positive, but we need to see this really close above this level. We barely closed above this high and this high back over here. I would call this early stage bullish confirmation, but I would not get overly aggressive to the upside. Okay, I really wouldn't. We could see this waffle around for 3, 4, 5, 6, 10, 12 weeks, if not more, trying to struggle to get above this level. Once we get above this level, yeah, okay, now we have some real confirmation. I'd like to see at least 2 or 3 weeks of data confirming this, but once we break this high on a ending bar close, end of week close, then we could have a real solid uptrend. Oh, down here, the consumer sentiment index has just moved back to pretty much par. And as I mentioned to you over the last couple of weeks, I think we're going to be looking at this. I think we're going to see, you know, a good solid year or so of chunking around over here near this middle area, which is where we're at, which, again, I would call a labored melt-up type scenario. Okay, the Custom Innovation Index, this shows more clearly the big 25 to 45+% rally in the technology sector. We are outside of this consolidation range. We could easily revert back up into this 80-90 area here, but be cautious, ladies and gentlemen. Once we get up into this upper area, actually above this channel right here, this is really bubble territory again. So be well aware. We're starting to see technology move into bubble territory, and bubble territory can collapse and revert very, very quickly. I would have been happier to see this move in a more consolidated basing mode and then some organic trend back to the upside. But we are back into bubble territory. If this continues upward for the next 3, 4, 5 weeks, then you need to be very cautious, because the next correction could be really a 15, 20, 25% correction of this last little upward move. Okay, gold monthly cycle chart. Gold is consolidating. Gold is still in accumulation. It's an amazing phase right now. As I mentioned to you back over here, this shows accumulation. Very similar to what happened back over here before we saw that big rally phase from 2018 roughly all the way up to 2020 and 2021. Now, where are we? Look, we're almost at new highs. And look at where this cycle phase is. The big appreciation phase is going to come in 2026, 27, 28, 29. This is massive accumulation taking place at higher prices. Once we get into this real big price appreciation phase, that's when gold's going to run from, you know, 31 to 3,500 up to like 9,900 or higher, and it's going to be very powerful. But this is big accumulation, ladies and gentlemen. Gold and silver. If you're a big gold and silver bug like me, boy, oh boy, have some fun. Try to go get some extra stackable coins or what have you. This is big accumulation right now. Next, we have the global asset index moving a bit higher. Like I told you, could still labor, could still struggle. Kind of like this, could still struggle to come out of this phase, or maybe even more so like this. Could bottom, could base, could consolidate literally for a year or longer. Look at how long this consolidation phase is. So from the peak in 2020 right over here, we topped. We came back down, rallied back up, double peaked near the end of 2021, and then now we've seen this roll downward. We've seen, this is really the longest extended consolidation or unwinding of excess phase in the global asset market that we've seen in decades. And I believe we could continue another 3 or 4 years before we attempt to see some big move up. Maybe 2 or 3 years, but it's going to take a while, folks. This is not going to just turn right back around in 2 weeks. Large cap index, same thing. You know, peaking back over here in mid-2020, double peaked again back over here in 2021, really showing you the U.S. large caps have unwound quite a bit of excess. We haven't seen anything like this for quite a while. I mean, we had a period over here in 2012 where it took almost 2.5 years to go ahead and get out of this cycle phase. We're at a point right now where it's taken almost 2.5 years to reach the low. And hopefully this is the low, and hopefully we'll start to see it accumulate. It might take another 2 years, till mid-2024 and 2024 before we start to see some real appreciation to the upside. Okay, Consumer Engagement Index. Consumers came back, this is weekly, came back very strong. Let me check here, this is monthly. I apologize. It says weekly, but it's actually monthly. It came back very strong in December. This is January. You know what, folks? Unless we see some real follow here through the end of January, we could be just continuing to flag out into this sideways channel. So remember, I kept telling you how we had to get above this purple line to see some real upward engagement activity in the economy, and then eventually get above this pink line to show that we're actually moving in an upward trend. Starting to think that we're just going to flag out, just go sideways for the next maybe 6, 10, 12 plus months, apexing somewhere back over here near the end of 2023, early 2024, and then maybe get a breakout. So be very keenly aware that this is not the same market. This is not, I mean, I don't know how to say it any other way. Without a major catalyst, the markets are trying to find a bottom. The way they do that is what they call hammer out a bottom. They do that by building a momentum base and retesting that momentum base over extended periods of time. And that's where we're at with this setup right now. If some sort of a catalyst happens, if, banks collapse, if we end up in war, if we end up in some sort of a global crisis mode, then yes, we're probably going to see the markets end up tanking. But if we continue to just struggle through this excess unwinding, I really believe we're just going to see this flag out sideways, maybe a little bias to the upside, especially the U.S. markets, because foreign capital is being drawn to the U.S. dollar strength and U.S. economic strength. We could see this flag back out a bit, but we need to see the consumer really come back into play here. We're not seeing that yet. Next, the cash flow index, again, stalled out. Very, very common here, folks. We're below these lower levels, okay? I want you to be aware, but we could very easily see it stall back out down to this 1.3 area, which is why I'm telling you the next 3 or 4 weeks, rephrase that, the next 3 to 7 plus weeks could be just rather boring. Just stalling sideways, going nowhere, waiting for new data, waiting for something to actually become a catalyst. So be aware, we may not have any real big moves in the SPY or the NASDAQ or any other major sectors, including the consumer sector and the transportation sector. Next, the cycle phase, accumulation cycle phase index. Doing what I suggested, it's flagging downward here. You can see we've rolled downward here in this chart, okay, and rolled downward here. This is good for identifying an upward bias in the market. But again, we've got this huge flagging formation, and I am not seeing, let's put it this way, I'm not excited about any real upward opportunity right now. After calling for this bottom and really picking it all the way through this peak. Remember, I was warning everyone that we're going to end up at a topping formation, and back over here I was telling everyone to get to 60, 70, 80% cash, and back over here I was yelling pretty much to get to 80, 85% cash and protect your stops. It's going to happen. It's going to roll over. It rolled over, and right about this area I started saying, boy, this looks like a wave 4 formation. I'm looking at an ABC formation or an ABCDE formation, was picking target levels right above the COVID high, which is right over here. Sure enough, that's where we ended up. My initial target levels were down in the midpoint of the COVID area and back down around this 2015-16 area. I revised that to the pre-COVID high area. I've been telling everyone that we had a good solid bottom. In fact, I've got videos on YouTube. You can go look them up. I mean, I really think that we set up a bottom. I think we're flagging out. I think we could see some weakness over the next couple of weeks. Like I said, we have to watch these lows. These lows are going to become very critical in the future, but we are flagging downward. We would be looking for any signs of weakness. Weakness would be upward trending Fibonacci bars here. So we want to see this flag back to the downside and kind of build some momentum so we can get into a breakout. We do not want it to go the other direction. That would indicate that something is breaking. Either central banks or consumer or real assets. That is where we're at. Now the rotational modeling system, once I get there, has gone into bullish trending. We had a trigger on the 3rd. We took an entry at 411.59. We are now 100% bullish. We are going into a solid uptrend. This is your investment modeling system. We've done this 2 or 3 times over the past couple of years. Generally, this is when we start a real solid melt up. I will warn you, ladies and gentlemen, that like I said, I've told you we could trend sideways. It could be a slow start to this trend, but the rotational modeling system has turned bullish. We are now 100% bullish in our rotational investment modeling system. You should be 100% fully invested with your 401k and IRA, and you should be following this for signs of weakness. We have historically been doing very well. So this is your trading account allocation. Is now I'm staging us into this. So 50% is available for stock trading, 25% cash, 25% metals. Alternately, you could be 65% stocks, 35% cash. The purpose behind this is that one account is your investment account. This is what you do with your nest egg. This is your 401k, your IRA, your retirement account. This is your alternate smaller trading account where you can then trade different shares and equities. We are keeping a moderate cash reserve because, like I told you, I do not believe we're going to have a huge opportunity. I just don't see it. My indicators, my systems, my modeling systems are telling us we're probably going to stay within the last 24 months high-low range, and we're probably going to be melting upward at a very labored rate. So I don't see any real opportunity other than very quick targeted trades, simply because I don't believe we're going to have a great big, 20, 25, 30% rally in the SPY. I just don't see it happening. And the historical results of the MENT rotational modeling system have been very good. You can see here that while the S&P has been rolling sideways, the MENT rotational modeling system is almost at new all-time highs. And the reason why we're not at new all-time highs right now is because of the way it's structured. It trades 75%, in a daily modeling system and 25% in a weekly modeling system. The weekly modeling system has been long. We had taken a little bit of pressure here, but we really hadn't seen too much. We had one drawdown in 2022 on a quarterly performance of about 5.5%. Really was nothing when you consider how the largest funds did. But again, the purpose behind this is threefold. Number one, you get the investment modeling system. Number two, you get all of my proprietary research, which I'm delivering to you in these videos, trying to be as clear as possible, looking for 5, 6, 12 months out into the future. And then you also get the live trades and the other algos that give us weekly and daily swing and rotational modeling system trades. So pay attention. This could be a very good year. Okay, we're looking at 2023 right now. It could be a very good year. I'm hoping that we're able to get something kind of like in the mix of the, let's call it the 5.5 to 7.5, 9% range. So maybe something more like 2003, 4, 5 area. That's kind of where I think we're at right now. I doubt we're going to get these 19, 20% type profits like we had back in this area. I would be very comfortable with a 7 to say 10% profit range for the rotational modeling system, because I believe that's all the market's going to give us this year. Next year, 2024, 5, 6, oh boy, look out. We could have some really big profits then. Okay, guys, remember, come back to MENT.com, please. Share with your friends. Come down, take a look at what you get. If you have made any money with my research, you already understand the value of what I'm doing. I'm trying to help you guys out and prepare you. I want you to come in and learn to use the tools that I've delivered for you to get to make your own trading decisions. And remember, all of this basically boils down to, you know, under $2 a day, really, every month. $55 a month on a monthly subscription, or $41 a month, $42 a month on an annual subscription. If you think I'm helping you and you value what I do, then come help me make this even better. All right, guys, remember, you want me sitting around here doing research, okay? You want me finding the next great solutions and building out new tools and technology for you while I keep doing these updates. Your job is to take this information, digest it, learn from it, and learn to become better traders using my proprietary research. Thanks again, guys. Off to the next video.